Seeds of Wisdom RV and Economics Updates Wednesday afternoon, the 8th of October 25. Listen to the full version on the official dinarreport.com blog and become our supporter on Patreon. Good afternoon. Dinar recaps. Gold hits record as markets crack under political anxiety. When uncertainty rules, gold often becomes the default barometer of systemic stress. What just happened? Gold surges past $4,000 per oz. Spot gold climbed approximately 1%, breaking through $4,021.22 per ounce. A year-to-date gain of over 50%. Flight to safety. Central banks buying, ETF inflows, and a weak dollar fueled the rally. Filled circle markets falter elsewhere. Asian equities dropped, MSCI Asia ex-Japan down approximately 0.8%, French stocks and euro weakened due to political disruption. Drivers behind the surge: political strain and fiscal shock, France's government collapse, Japan's political shifts, and extended U.S. shutdown heightened systemic risk. Fed rate cut expectations. Anticipation of easing from the U.S. Federal Reserve is pushing investors toward non-yielding assets. Dollar weakness. As the dollar weakens, gold becomes more attractive in local currencies. How this ties into global financial restructuring. Safe haven demand as a signal. When capital flees toward gold at record levels, it broadcasts systemic mistrust in conventional financial and monetary structures. Gold as a strategic reserve. Central banks accumulating gold imply a hedging shift against fiat volatility, sovereign debt risk, and potential devaluation. Uncertainty zones become financial fronts. Political instability in powerful nations translates to stress in the global financial architecture, pushing investors and states toward alternative systems. Momentum for de-dollarization. Weakness in the dollar and surges in gold support narratives that the dollar's dominance is under structural assault. Why this matters. Key takeaway. Gold isn't just glitter, it's a canary in the coal mine for the cracks forming in the global financial order. When gold breaks records amid political turbulence, the signal is clear. Markets are testing the foundations. This moment isn't an anomaly. It's a precursor to major structural shifts in reserve strategy, capital flows, and monetary topology. Nigeria eyes debut global SUKIC implementation. Abuja turns to Islamic finance to stabilize borrowing costs and diversify funding sources. Debt strategy and new instruments. $500 million sovereign SUKIC. Nigeria is preparing its first global SUKIC issuance, a Sharia-compliant bond, as part of its FY 2025 borrowing plan. Broader funding mix. The government aims to raise up to $2.8 billion through new instruments, including Eurobonds and domestic issues, to fill fiscal gaps and refinance maturing debt. Why it matters. Nigeria's external debt servicing has become one of the fastest-growing budget items, straining reserves and pushing officials to seek non-traditional, interest-free funding streams. Strategic positioning in global finance. Islamic finance hub vision. Nigeria is positioning itself as West Africa's first Islamic finance center, appealing to Middle Eastern and Asian investors seeking halal assets. Diversifying beyond the dollar. The SUKIC initiative aligns with a wider move among emerging economies, especially within BRICS-aligned and Global South nations, to lessen reliance on dollar-denominated instruments. Fiscal reforms under pressure. The Buhari and Tinubu administrations have pursued reforms under IMF watch, yet rising inflation, approximately equals 28%, and currency depreciation continue to erode fiscal flexibility. Linked to global financial restructuring. Nigeria's SUKIC debut symbolizes a growing trend: monetary and debt diversification as nations hedge against the volatility of traditional Western-led systems. Emerging economies are turning to gold, digital assets, or Islamic finance to regain sovereignty. These tools provide insulation from sanctions, interest rate shocks, and global liquidity crunches. As Nigeria joins this wave, it signals deeper participation in a multipolar credit system increasingly defined by regional blocs and non-Western capital. Why this matters. Nigeria's entry into global SUKIC markets marks more than a borrowing experiment. It's an alignment with a new architecture of finance grounded in sovereignty and value-based credit systems. If successful, this could set a precedent for other African economies to follow. Japan edges toward tokenized finance, prelude to token government bonds? While a full tokenized sovereign bond hasn't launched yet, recent moves in Japan's digital asset infrastructure point toward that future. Tokenization signals and infrastructure moves. DCJPY token launch. Japan Post Bank is developing DCJPY, a tokenized version of the yen, to go live by 2026. This would offer instant settlement for digital securities and transactions. Japan-Korea collaboration on digital bonds. The two countries are discussing cooperation to create digital bond frameworks. Active token use in real estate. Japan's current tokenization is primarily in real estate and smaller issuance types, not yet sovereign debt. These steps are small but foundational, building the rails before issuing tokenized sovereign bonds. Challenges and preconditions. Regulatory clarity needed. Legal frameworks around tokenized securities, custody, and compliance must be established. Liquidity and market depth. Tokenized bonds require sufficient demand to keep spreads tight and trading efficient. Technology and interoperability. Blockchain networks used must integrate with existing capital markets infrastructure. Sovereign backing and trust. Tokenized bonds must retain the security and guarantees associated with government debt. How this ties into global financial restructuring. Incremental transition. Japan's tokenization efforts are signs of gradual adoption of new financial rails, rather than abrupt revolutions. Diversifying monetary tools. Token sovereign bonds would allow programmatic features, payments, interest, conversions, and complement digital currencies like DCJPY. Reduced friction in capital flows. Tokenization can lower costs, speed up settlement, and reduce reliance on correspondent banking. Sovereign innovation. As more nations experiment, the architecture of sovereign credit and bond markets could shift toward programmable and modular formats. Why this matters. Key takeaway. Japan hasn't yet issued tokenized government bonds, but its recent moves suggest the foundational layers are now being laid. These developments reflect the larger trend: countries building new financial infrastructures that could one day carry sovereign debt in digital form. When tokenized sovereign debt becomes viable, it won't just change issuance, it will recalibrate how capital travels globally and who holds leverage in the system. Listen to the full version on the official dinarreport.com blog and become our supporter on Patreon. Source: dinarrecaps.com